Hey guys, welcome to the Raising Capital Show. I'm your host, Nate Dodson, along with, let's see if it works,
Jillian Sidoti. I did it. I was ready this time. I was so ready. Nate tells me every single time we do one of these live streams is that he's gonna start off until it comes to me saying my name, and every single time I hesitate. But today, I was successful. So this is a good day. It's going to be a great interview. I'm very excited about what's going to happen today. We have some very special guests. Paige Panzarello from the Trillion Group. That is her fund, but you can find her at cashflowchick.com because what does she do? She shows you how to cash flow with notes, which is what we're going to be talking about today. And we're also joined by Fred Moskowitz, who actually wrote a book on note investing. So if you're interested in reading about that, you can find that. It's called The Little Green Book of Note Investing. And we'll give you all the links in the show notes and everything like that. And you can also find him at fredmoskowitz.com. But without further ado, let's get to it, because I believe right now at this point in time, and I think Nate agrees with me, that note investing should be something you seriously consider as an important part of your investment portfolio. And Nate, I'll let you kick us off with the first question.
Yeah, well, I mean, just to throw in my 2 cents, I think it's a no-brainer that with higher interest rates, with a tighter real estate market, having that a little bit more of a secured interest, being a debt holder, makes a world of difference. Oh, we do have the echo from somebody.
I think it might be Fred.
Oh, Fred, we get to blame you. Plus,
sorry, Fred. We all
question.
tested earlier.
Wow, we're off to great. So I'm going to mute and test and see if the echo goes away.
Okay.
All right.
Gotta love technology, right?
There's always something.
Fred, are you muted?
So did it go away?
It went away.
I think so. Oh, wait, no.
It was Jillian. We get to call her out.
It's not you. I take it back. Sorry, Fred.
We do a process of elimination.
We do.
That's all. I think it's gone now, so we're good.
Okay.
Perfect. Well, let me ask you, Fred, for the people that are new to note investing, they've never done it before. Like, give me your pitch about why being in the note space in the note industry is the smartest thing in the world at this point in time.
Yeah, thank you, Nate. So note investing is a way to get exposure to real estate. You can invest in real estate without owning it because you're going to be owning the debt against the property. You're not a property owner. You are a secured lien holder. And the benefit of this is that you're able to generate cash flow and income while you don't have to have the management responsibilities of the property. And it's stepping into the shoes of the bank. Banks don't want to own real estate. They just want to own the loans backed and secured by real estate. And so if you're a person that already has a real estate portfolio, that's great. You can diversify by adding notes into your portfolio, which will generate cash flow and income. And there's a lot of other strategies, asset classes that we can participate in. I mean, Wall Street's great at creating alpha for us through investments and stocks that are focused on appreciation, and that's all great. But what about focusing a portion of your investments dedicated to strictly generating income and cash flow in a consistent and statistically successful manner? That's what note investing is all about.
Paige, same question to you. Like, pitch us on note investing today in today's market. Why?
I totally agree with Fred. And to compound on that, the interesting thing about the note market is that it is very market resilient. So when you say today's market, Nate, note investing is for any market. Truly, we are not bound by market cycles. As you know, there are some mediums in real estate investing that are very strategic in terms of when you go into that medium versus when you don't. Note investing is a year-round, 24/7. Doesn't matter what the market is doing, because we are the bank, and everybody knows that the biggest buildings in the metropolitan areas belong to banks, right? That's for a reason. It's by design. So we are not beholden to market cycles. We are very market resistant, market resilient. As long as you do good due diligence. And I know we're going to talk about that a little bit later on. I'm sure we'll get into that. But, also why notes? Control. I, as a note investor, am not beholden to literally anybody for the success of my note. It literally is dependent on my buy box, my due diligence steps, the team that I have in place to manage my expectations. And I don't have to rely on whether or not toilets are going to bust or air conditioning is going to bust for profitability. I don't have to rely on whether if I'm fixing and flipping somebody else's broken down house, that now becomes my problem. I don't have to rely on whether or not the contractors are going to finish on budget, on time. I don't have to worry about whether inspectors are going to stall my project. As a note investor, like Fred said, I own the debt. It's secured by the real estate. And so your due diligence is very key in terms of your investment strategy, but you maintain a tremendous amount of control, even more so than your borrower.
Let me challenge you on something though, because
Yes.
I see like today's market with a higher interest rate as being really where it's attractive to be in the debt space, where 2, 3, 4 years ago, we're talking about such low mortgage rates. It just seems like it makes more sense today versus that time period. Could you speak on that a little bit?
Absolutely. So it depends on your investment strategy. So I am not a performing note buyer. So what you are speaking about, perhaps, if I'm hearing you correctly, is somebody who's going to step into the shoes of a performing note buyer. And yes, that might not be, you might not be excited about 0 or up to 3% interest, because a lot of these a lot of these notes that are performing, that are sold today, have very low interest rates. However, I focus on non-performing notes, which means that the borrower has stopped paying. And for me, I've been known to work with my borrowers hand in hand, because again, as the bank, I don't really want the property. I'll take it if need be, but I don't really want the property. I want the debt secured by the property. And my focus, my goal, my strategy, and my end game is to try and work with that borrower that has stopped paying their mortgage and help them to start paying their mortgage, so I can cash flow and also hopefully create a little chunk of equity at the back end when I exit that asset. In so doing, interest rates don't really play a factor, because again, if the borrower has stopped paying and I get them to start paying, that's in the form of a trial payment plan, and it goes into a loan modification. Now, I've been known to modify loans from a 2% interest rate up to a 6 or 7 or 8% interest rate with the consent of the borrower. How do I do that? That sounds very counterintuitive. And why would a borrower agree to something like that? Well, the reason is because normally this is only a strategy if the house is underwater. So right now we're seeing kind of overinflated values. But if the house is underwater, there's typically a cushion of what I am owed versus what I could actually get. And so the borrower, I can actually defer or deflect or forgive a lot of that money, and the borrower will now agree to pay a higher percent interest rate and start performing on that loan. I hope that makes sense.
It does. If it only made as much sense as how this machine works. So we got joined by somebody else, Zeke Martinez. It's good to see you, my friend.
Good to see you guys. Sorry I'm late, but I'm here. and I'm looking forward to chatting with you guys.
Jillian,
it wouldn't be an entrepreneur podcast if we didn't have 17 different hiccups. That's the way we roll. But that's what the entrepreneur life is like, right?
And we're good at resolving and handling each of those hiccups. That's our
exactly.
life.
You have your problems, you have your issues, and you just keep going through the mud to get to the end, so that's what this podcast is all about. I have an important question for all of you, because you're buying these notes. A lot of them are on primary residences, and the people, and Paige, you mentioned you buy non-performing notes. And so there are some really tough laws when it comes to the situation of if you're dealing with a resident, somebody who lives in their home and isn't paying their mortgage. How do you guys handle those situations, and how do you handle them across state lines? Do you only invest in certain states? Do you do it yourself? Do you hire a company? Tell us about that process. And Zeke, since you just got here, I'll start with you.
Okay, thank you. I'm Zeke Martinez. I'm in San Antonio, Texas. The way I deal with it is I own a mortgage servicing company, so we deal with it on an ongoing basis all the time. So it's just part of our normal operations, and it's consumer protections that we're dealing with all the time with multiple just agencies. So when it comes to buying, I guess, a defaulted or dealing with a foreclosure, obviously we have counsel to deal with that. Well, after a while of seeing the scenarios, you start understanding what the rules are. So I can leverage my company, basically does mortgage servicing.
I kind of want to point something out before we get too deep, because I love this panel because they all focus on really different things.
Yeah.
Paige, you're focused on the non-performing. I know Fred, he has a fund. He's focused on performing notes that he's buying. And then we have Zeke, who's focused on more residential opportunities that he's a mortgage originator rather than a buyer or just an investor. So it's like everybody's coming to the table with completely different perspectives. And I don't think we did a good job pointing out why this illustrious group is here to be the illustrious group.
This is the diversity of this industry. There's so many different business models, so many facets of the mortgage industry, and they're intertwined and interrelated, but each of us here has chosen to focus on one specific area, and that's great. That's great. It goes to show the tremendous diversity that there is in this space.
Yeah, you definitely have options. I think that for me and my fund, we invest in non-performing notes, and the reason that we focus there is because I'm able to build in a larger discount upon purchase of the note, and that gives me a margin of equity, and it mitigates some risk for me. Performing is immediate cash, right? So you, like Fred, and I'm the cash flow chick, so I love cash flow, believe me. And to Jillian's point, I target states where my money is in constant flow. And what I mean by that is unlike Zeke is a licensed servicing company. I am not, nor do I want to be as an investor. So I hire, and I'm sure Fred does as well, we hire licensed debt collectors that work on behalf of us in communication with our borrower. I never speak to my borrower, ever. My licensed debt companies, my servicing companies, my loss mitigation teams, my attorneys, they all liaise with my borrowers. I do not, because I am not a licensed debt collector. And I don't know the laws. And so I protect myself by employing those people that do know the laws. I mean, I know the laws enough to be dangerous, but not on a day-to-day to handle borrower phone calls. So let me quantify that. but yeah, it's there's so much flexibility, as you can see, in note investing, and you don't have to do the heavy lifting. You can hire out people to do the heavy lifting for you.
Which is far different than Zeke. Zeke, could you talk about your business a little bit, just since you actually originate and you fund and you service and you're the one-stop shop?
I mean, it's sort of different angles. I do a little bit about what you guys do also, but I got into mortgage servicing accidentally. I bought a previous partner out because we did too many originations, and it morphed into a mortgage servicing company. But it's all residential mortgages or seller finance. So it's in the seller finance space. And at some point, those notes start to refinance or sell or default. And going through that process for 8 years, you see the patterns of, okay, worst case scenario is a bankruptcy and gets jammed up for like 2 years. And at some point, you can use the bankruptcy court to your advantage because they're forcing the payments. And you figure out what the angles are on the professional borrowers, if you will. And I also see the angle on the note acquisitions to buy those very discounted notes because people look at them as a ticking time bomb, and they are trading at a discount, but you can actually see the payment history coming out of the bankruptcy trustee to see if it's a willing and able borrower to take over. And you see that as a mortgage servicer, but you also see is a lot of the pain that the borrowers go through. And I've seen it personally after the GFC to try to go for loan modifications. So when you're doing a loan modification, you do need an originator license to do a loan modification. And sometimes that's to the benefit of your lender clients because they want the interest to be earned and they don't know how to restructure that. So the originating side, I got into it because we needed more notes to buy. And obviously there's a lot of borrowers that need easier terms, but mostly it was to try to go after the loan modification restructuring that's needed whenever there's a problem, and we deal with those problems day to day as a mortgage servicer on consumer mortgages. So after a while, to do that volume is hard, one at a time, matching one investor client to one note acquisition, especially where the prices are, where the notes are. So I also got recently into building out a note fund so that in the next 10 years, I don't have to be matching one to one. It can grow internally and the interest can compound and it'll reduce my workload.
That's really great. And then you make like is your primary cash flow and income from the origination, or is it something else?
So the way I would explain that is, I think I got this from Chase Bank. They said the servicing supports originations. Their servicing model works better in certain times because it's residual, and the originations work better in certain times. So they make more money whenever there's those times. And then the origination shuts down. Say when the liquidity shuts down, there's a market correction. So what doesn't shut down is the residuals off of the servicing. So the servicing supports the originations when those downtimes come. And it's there. They need to trade out of the mortgage servicing rights to generate liquidity to acquire more. So I picked up that from them, and I'm trying to apply that model on a seller finance base, a smaller pool, if you will.
And then what about you, Fred? Like, because now we're talking, apples and oranges with Zeke and Paige, and you're kind of squarely there in the middle. So where is the profit for you in your business? Because you're buying performing notes.
Yes, we're buying performing notes. So the profit comes from the long-term cash flow and income. It is slow and steady and very predictable, very statistically successful. There's not wide ranges of price swings or appreciation or anything of the sort. It's steady and predictable. And there's always a market for selling and buying notes of all types, all interest rates, some that were originated last month, some that were originated 10 years ago, and everything in between. And so there's always opportunity out there to place capital And we approach it from a long-term perspective. We're in for the long game. And over time, that cash flow and income can be reinvested, and it compounds and expands. Just like the words, whether you believe it was said or not, of Einstein, who said that compound interest is the eighth wonder of the world. And if you don't understand it, you'll be paying it. And if you do understand it, you'll be earning it. This is something largely debated about whether he said it or not, but the idea and concepts stand the test of time.
Yeah, no, that's a great point. And I'm wondering though, if for somebody who's coming to you and saying like, well, what happens if somebody has like a really low interest rate? Like, how do you work with them? How do you make money? Like, walk somebody through the process of how you're buying a note and then still being able to make that slow and steady cash with somebody who perhaps has a 3% interest rate when interest rates right now are at 6.5 to 7%.
They're double that. So the way that's handled in the marketplace is the interest rate on a note. If it's a fixed rate note, it doesn't change. So from the borrower's perspective, they're paying whatever was agreed to in the terms of the financing. However, what happens is that when we purchase that note on the secondary market, pricing is impacted. If it has a low interest rate, there's going to be more of a discount warranted. And so this is something that's dynamic and changes over time. And if the opportunity presents itself to myself or to any investor, they can choose to either purchase the note or not. And so if it meets your buying criteria and is attractive to you for what you're looking for right now, taking into account your cost of capital, your operational overhead, and all of these other business details, you can decide it's going to make sense to buy this note, or maybe you'll say, no, I'm not going to buy it, and move on and focus on your next deal. And so that's the way we handle some of these differences and pricing on notes that have a low interest rate. In general, they will trade at a greater discount.
Can I chime in?
Yeah, no, that makes
on that?
Yeah, please do.
So I think sometimes people get stuck on the rate more than the actual interest that they're earning. Yep. If you take time to actually look at the variable, how interest is calculated, one of the main ones is time. And you have to disclose that on a closing statement to a borrower. Regardless if they understand or not, they'll understand they're paying almost 2.5 times the amount of their principal over time. So that interest that's being earned is more important than the rate because of the variable of time. And so that's what you're after as an investor. The thing is, it takes patience, and that's the hard part sometimes. Some investors are actually looking for time as far as their lifestyle, like they want a passive way to earn interest without having to operate. So we do the servicing and the asset servicing so they really don't have to do that. If you own a note, it's all good until something goes wrong or it gets sold, and it's a good thing. You have a payoff of your principal. Now what? Now you're no longer passive. You now have to make a business decision of what am I going to reinvest on. So having an operator that can help with all that helps, but understanding where the earnings are coming from, it is exactly what Fred is saying. It is the interest that we're after as the mechanism. It just takes time to make that happen.
Paige, I just kind of assume that you have a completely different outlook on due diligence, interest, and how it works with non-performing notes. Could you speak a little bit on that? I honestly, I think that, you've got the sexiest kind of industry or style that you're focused on versus the low and slow, which is safer and pays these regular returns. So it's just like night and day different. Could you speak a little bit to that? Yes
and no. So slow and steady wins the race. And I honestly, I don't really view my form of note investing as sexy. It's very intentional. It's very calculated. It's very strategic. And that's one of the things that I really love about note investing is that when, like Zeke said, it's all great to own a note until something goes wrong. As a non-performing note buyer, I go into it with eyes wide open, right? So I already know, and there's many due diligence steps we don't have time for. I mean, I've literally taught on this, and it's a full, 10 to 12 hour day just to cover the basics of what you have to do in terms of due diligence. But that being said, the beauty part is that as a note investor, and it doesn't matter what form we go into, as a note investor, because in your due diligence, you receive what's called a digital collateral file if you're buying an existing note. Zeke is a little different because he's originating notes. But if you're buying an existing note, you get a digital format copy of all of the paperwork that has gone into that note, including, and I tend to buy notes that are not self-service, which means that it's a seller finance deal where they're just collecting the checks themselves. They're not using a licensed debt collector. I stay away from those. I will buy notes that are institutional paper that use licensed debt collectors. And the reason for that is because they keep very detailed records about every conversation, every attempted phone call, every payment that's made, not made, every past due notice. Every single piece of information goes through that licensed debt collector. So when I'm looking to purchase a note, one of the strongest points of the due diligence outside of the state, and Jillian, I didn't really answer that question, but yes, there are states that I avoid because my money is sitting stagnant. For instance, New York has a 4-year foreclosure timeline. And I don't like to sit for 4 years waiting for my money to make money, right? So I avoid New York. There's other states involved as well. And that's all part of the due diligence. But I can go into a note knowing that, hey, my outcome, I want to buy this thing as a non-performer at a bigger discount, mitigate my risk, work with the borrower through my licensed debt collectors, get them to perform, modify the loan, which is, by the way, a reset, right? When we do a loan modification, that's a brand new loan. And as note investors, our profit is interest. So when you refi a loan, you're starting the clock all over again, right? And the bulk of your mortgage payment is interest especially when you reset the clock, okay? But I'm going to know from the service or collection notes whether or not a borrower is going to want to go into a loan modification. I've been doing this long enough to know if you pay attention to those collection notes and read where the borrower's mindset is or has been, you have about a 90% chance of hitting your goal. Before you even buy the note, you know that information. So your due diligence is super key, but it also gives you the predictability of outcome that Fred likes as a performing note buyer, right? But for me, I anticipate already going in that things have gone wrong. So there aren't really a lot of surprises for me. Sometimes there are, borrowers can get a little shifty sometimes, but if I've done my due diligence well, I'm protected. And I don't do deals just to do deals. If they fit in my buy box, if they meet my very strict criteria in terms of due diligence, then I will buy the note. I don't fall in love with houses. I fall in love with the money, right? The numbers. That's what I fall in love with. The security and the numbers. That's what I look for.
Jillian,
with that being said, do you guys ever go and look at these properties? Do you go, you get a package of notes from a bank. Do you ever go and drive by them, or are you just trusting
Never.
the internet and the spreadsheets that they gave you?
Never trust the internet.
There is no need to visit a property physically for any reason. What are you going to do? Are you going to go knock on the door and say, hi, we're from the lender. We're here to pay you a visit. You first of all, you're not allowed to do that. There's very strict rules about what Paige mentioned earlier, conversations with borrowers. So as a lender, that's not allowed in most cases. And also it doesn't add any value at all. So what can we do? What do? We utilize technology. We leverage vendors. If you ever had a need to, as part of your due diligence, to check on a property, you can make a phone call to a vendor that does field work. They will go out to the property, take exterior pictures. They'll verify the occupancy, that someone's living there or not, or it's a vacant property, and send everything back in a report to you in about a day. And they may charge you a very nominal, reasonable fee to do that. And there you go. I just looked at a property located halfway across the country from me, and 10 others, because we're looking at buying a package of loans. And so that's how we do it. And that works very well and gets the job done.
I have a comment on that. So basically, Fred's saying he checks on them with other ways, technology or people. I think that's wise. But he didn't have to go out physically and do that because you have to fly across the country. For us, we do check them just because I've seen scenarios where you're buying an existing note, because we do buy notes too. The origination is something new for us because of the loan modifications. When we're modifying a loan, there's opportunities also to clean up a problem that somebody has created, like bad consumer documents or bad terms on a deed of trust or waivers of liability you can add in there, just so that if they default again, they can't sue you for it. Basically takes their foreclosure defenses out when you modify. So it's an opportunity to protect yourself and to clean up the process that somebody might have made down the road. But it's a little specialty niche that we have to continue to buy and protect ourselves. Going to the actual checking of the houses, I have seen notes, that the house is burned down.
Yep.
They're still paying on the note because they don't, I guess, know they can just foreclose and it's not the end of the world. But I have seen notes that our borrowers are still paying on and the house is not there.
And I have a blend in between that. So I don't tend to pay for things that I don't own. Let me retract that. Yes, I do. There's certain due diligence steps I do pay for, but I try to keep as much money in my pocket and my investor's pocket as possible, right? I don't go willy-nilly about just spending a bunch of money. I will call local realtors and I explain, I don't get too in the weeds. I just say I'm looking at a property in their local area and would they be willing to do a quick drive-by and give me a quick one-page CMA in terms of value and snap a couple pictures and send it to me. Most realtors will do that for you for free. So I will do that. And yes, Zeke is absolutely right. You have to lay eyes on the someone has to. You don't have to get on a plane and fly there. And I never do. But I will use the resources of a network of realtors that I've built over many, many years. I'm also a licensed broker, so I have my own network as well. To reach out to a local realtor. And if I can't find somebody, then I will do what Fred does. There are plenty of services that are out there that you can pay a very nominal fee to go out and take some pictures. In terms of the due diligence package, though, it's very interesting because most institutional paper has monthly visits from a property preservation company that include pictures. So if the property is vacant, you actually have pictures in your collateral file before you buy the note. And sometimes you have to ask for this. But that you already have interior pictures from the property, from the selling bank, because they have property preservation that goes out on a monthly basis or a quarterly basis. Sometimes if the property is not vacant, if it's owner occupied, then they'll just do exterior drive-bys. So pay attention to the most recent. If it's been over a year, then obviously you want to contact a realtor or a friend or a fellow investor or whomsoever to lay eyes. on the property and take some pictures, because Zeke is absolutely right. You have to make sure that the building is still standing, because that's your collateral. So.
And that's a great point about the collateral.
Yeah.
I mean, like and the fact that people are still paying on houses that burnt down is incredible to me. And I want to actually backtrack to that for a second. I'm wondering do you think they collect the insurance money thinking they're going to restore the house and that's why they continue paying? Or like, walk me through that, because that's unbelievable to me. I'm wondering if they just have so much equity in there, they're afraid to stop paying.
The scenarios that I've seen are they didn't pay the insurance. That's the reason why the house burnt down, because there are some mortgages that we've taken over servicing that are not escrow for insurance. It's a perpetual defaulting borrower. So if they're perpetually defaulting on the payments, they're not going to keep up with their insurance. So all the servicing company can do is send out NODs, try to do forced place. It's in and out of forced place, and at some point there's a gap. And we have now learned that through servicing burnt houses, when the investor does not want to buy forced place insurance, we have purchased an umbrella policy that would cover a gap in those scenarios where you have perpetual defaulters that are not including insurance in their payment, because it happens. And then there's a burnt house and nobody knows what to do with it. Neither does the borrower. So the borrower is more of a lack of, I guess, knowledge of, okay, well, you don't have a house anymore. Your note is owed, but you didn't pay for your insurance. So there's nothing for them to collect on. I think it's more of they don't know how to get out of their jam on what they're going to owe on the shortage of their note versus what they could sell the land for. Or there's some type of sentimental value, like the parents passed away and it was the daughter that was staying there. She didn't keep up with the payments and the house burned down. So she's trying to do her best to keep it going, not knowing that it's probably better just to walk away from it, because it's a seller finance situation and they're going to foreclose on the land anyway, and that debt's going to be owed by your parents, not you. So sometimes it's a mix of psychology, of ignorance, just to put it lightly, of why they're still paying on a payment that they don't really need to. And most of the time it's for non-payment of insurance, not that they collected on the insurance money and went to take it to Vegas or something. If there was insurance money, the insurance company's not going to let them do that. They're going to require draws on the reconstruction of the house. They're not just going to stroke a check for $100,000 or whatnot.
Seems like a big risk for Paige as well. Like just having the documents and just doing a BPO or a CMA. How do you know that the insurance is still in place and actually still good?
You don't. And I don't. And so when I buy the note, the very first phone call I make is to my forced place insurance policy, which is what Zeke was just talking about. We as the lender have the right to protect the collateral that is securing our invested dollars. So even though they may have insurance in place, until I get the hard copy collateral file and until it's transferred to my servicer, which is about a 45 to 60 day window sometimes, I would rather pay that monthly premium for my forced place policy on that asset to guard and cover and protect my invested dollars, which can be refunded, by the way, once we reach out to the through our licensed debt collectors. We reach out to our borrowers and they say, oh, we've got a policy that's in place, and we ask for their deck page. And once they send the deck page, I just send a copy of that and a refund request to my forced place insurance policy, and they refund my money in whole. So there's no gap for me at all. I am covered completely the day that I buy my note.
Fred, is it different for kind of the assets that you buy, or is it still a similar risk?
No, it is a similar risk, and we also make sure that the lender is named as an additional insured on the homeowner's insurance policy. And if that's something that can be checked prior to purchasing the note as part of due diligence. And if needed, there's the option of forced place insurance, which if you have a good relationship with an insurance broker to help you with that, you can get that set up. Or most loan servicers offer that as a service as well, that they can have it for you. And so there's always options to decide how you want to manage that risk.
A simple way to look at it, from the acquisition side is, if you're buying a note, if it's escrowed for insurance, meaning it includes insurance, the servicer has the insurance history. If they're making the payments, they're automatically paying the insurance. If it's escrowed including for insurance, it's insured. If it's not, that's where the risk comes in. So there is a gap, but you would have to get force-placed insurance and give proper notice to the borrowers to do it legally. You can't just force-place people. So it gets tricky. So if you're buying a note, if it's escrowed, no problem. If it isn't escrowed, the way we do it is we have a blanket policy that covers us, the acquiring company, in case we miss something on an origination or on acquisition of a note. So if it's not escrowed for insurance and the house burns down in those 45 days, yeah, there's no insurance on the actual individual house, but the company has insurance to cover that gap. It's like gap insurance on a car or an umbrella insurance on a company. It covers those gaps when you're acquiring notes that are not escrow for insurance.
So if somebody wanted to get into this, any one of these, like other than investing with any one of you guys, because anybody can do that, which is probably the easier path, obviously. But let's just say somebody's like, that's it, I'm adding notes to my portfolio, I'm doing it today. What would be that step one? Like, where are they searching? Obviously, Zeke, it's a much bigger lift, I think, to do what you're doing, because you got to get all the licensing and paperwork. But Paige, you guys, Fred, what would you say to somebody who's like, you know what, I decided I want you to mentor me, tell me how to start buying notes?
Yeah, this is a great question that I get asked a lot. And I always start with this distinction. Do you want to be an active investor or a passive investor? And this comes down to how much time you have. If you have a lot of time and you want to be hands-on, be an active investor, purchase a portfolio buy notes, build a portfolio and manage that. And that's great. If you don't have a lot of time because you're a business owner or you are focusing on your career as a professional, then look into investing in a note fund as a passive investor. And that might be a better fit for you. And there's no right or wrong answer. It's a very individual question to explore, but start with that first. And once you decide, then look into some education, read some books, listen to podcasts, attend training, attend conferences and events that are focused on education. There are all of these different avenues. So start with that, because you might be a little bit overwhelmed at all the different strategies and types of notes there are and what to do. And you want to spend some time to consider which is the one you want to start with, what's right for you, and look at who are the people you know and how are they successful, and can you learn from them as well. So those are really the places to start with when you're considering what you want to do. And with notes, when talking about what type to get involved in, you have to find out what you're comfortable with your risk tolerance. For some people, they have a very deep risk tolerance, and that's great. And others may say, hey, I'd rather focus on safe, secure notes with a lot more stability, and that's fine too. And what happens over time is, as an investor, you gain more experience, you gain more expertise, you've solved some problems, you've had those hiccups you've had to work through, and then you get more comfortable with taking on more risk as time goes on. And this is the normal evolution of an investor for anything, any investing. This is a natural progression. And so I find it a really compelling argument to really look at it from that perspective and that focus.
Yeah, Fred is absolutely right. You really have to start with yourself and sit down and have that meeting, and that evolves as you evolve as an investor, right? I call it what's your what. Everybody has a why, and that's a very personal thing. But what is your what? What do you need right now? What kind of time do you have to dedicate to this? What is your risk tolerance? Just like Fred said. How much capital do you have to deploy? Are you okay as a singular note investor? You might have $100,000 in cash that you can, because notes are a cash business. There are no financing notes, just so you know. But you might have that $100,000 in cash that you are willing to deploy toward a note or a couple of notes. But what is your risk tolerance in having that $100,000 in one or two notes versus maybe investing it with somebody who does this and the security, who has a registered fund, who is buying 10 or 15 notes so you can enjoy the blanket and the cushion of those 10 or 15 notes if those one or two might go a little sideways, right? So there's all kinds of different things that you need to ask yourself. And then if you decide, hey, I'm willing to be an active investor, I am willing to take the risk of putting my 100,000 or 50,000, whatever it is, into one or two notes. Now you have to educate yourself. You don't have to pay a ton of money. Education is out there. There's plenty of it. I used to teach live. I don't do that anymore. I'm too busy. Everything is online. But educate, because you can literally go out right now, today, after this webinar, and go and buy a note online. But if you don't know what you're doing, if you don't know the due diligence steps to take, if you don't know how to check for chain of title, if you don't know the team members that you need to have in place, you're going to get hurt. So education after your own mental meeting with yourself is key in this business, in any business, really, in any, adventure, but it's really key if you're going to be an active investor.
Do you suggest like a mentorship program, an educational group, a mastermind, or just whatever fits your own style?
I think every individual is different. I don't want to say that you have to go out and get a mentor. No, not necessarily. With technology today and the internet and meetups and meetings and virtual meetings and conferences, there's so much free information out there. And this community, the note investing community, I will say this, is a very collaborative community. I think the gentleman would agree with me. Fred and I have known each other for a number of years because of the note community. And we may be competitors, and I use air quotes, but it's very collaborative. I know that I can pick up the phone and call Fred and vice versa and say, hey, Fred, what do you think about this? Can you noodle on this with me? And he would. And it's a very, very collaborative community. Even though we're competitors, it's very collaborative. And you don't have to have a $40,000 mentor out there. They're out there, but you don't have to. There's plenty of information that's very nominal, under $1,000, if not free completely.
Yeah, those are great points, Paige. I think that a way to really sum that up is surround yourself with some successful people. However you do that, however that works for you, get around others, get into communities, attend live events and conferences so that you're around other people that are successful at the thing that you want to be successful at. And start with that. That's going to really propel you. And yeah, definitely in the note industry, we all know each other. It's a small world for us. And we may be competing against each other in a bidding situation for a pool of notes. And then the next month we may be collaborating together on something else. And then the next month we could be counterparties in a transaction of sale. Or maybe we call each other up and say, hey, Paige, do you know a servicer you can recommend that handles this type of asset and they're good at it? And she'll say, of course, Fred. Yeah, here, call Sally from this company. They're really good at that. And so that's how things work. It's all based on the relationships. I was at an investment conference earlier this year, had a chance to meet Zeke for the first time in person, which was wonderful. We had some really great conversations, and who knows what will come in the future based out of that. But it's all about building relationships. It's one of the most important things for success in this industry.
Mm-hmm.
So, I mean, that is gold advice right there, is that go out and make friends. Just start getting to know people and adding people to your Rolodex and keeping in touch with them and adding value to them so that they someday can add value to your business. That's great. And by the way, Paige, telling people not to buy a $40,000 coaching program is crazy helpful, because so many times people think like, I just need somebody to tell me what to do. I need somebody to hold my hand. I need. And yeah, you're right. Like, so much information out there now is free and there's folks like yourself who have information out there for free that they can go and get those things. I mean, I've done my fair share of note investing, and I will tell you, it's a lot of work, people. So if you get into it and you find that it's not your cup of tea, that happens. That happens. There's going to be times in your life where you're like, I'm going to forge ahead and do this new business, and it doesn't work out. You can find somebody like Zeke or Fred or Paige to either take whatever you started off your hands or help you find a more passive way of investing, so that you're not killing yourself trying to learn a new industry and manage it all as well. But don't sleep on notes. Don't add notes to your portfolio. That's one of the few asset classes I've never lost money in. I don't know. I can't speak for everybody, but for me, it's one of the few asset classes I never, and results not typical, by the way.
Yeah. And here's another thing. I want to touch back to Nate's initial question today, which is why notes right now? And I want everyone here to think, has there ever been a time in all of our lives where debt and financing was not used to purchase real estate? I mean, it's a primary piece of just about every single transaction, especially if it's an investment property, then it is. And so debt is always a part of the capital stack on a purchase of a property. And because of that, there's always a need for liquidity and then the buying and selling of debt. And so there's always opportunities out there, no matter what the real estate market cycle we're in, no matter what interest rates are. Loans are used to acquire property. People refinance loans that they have already, and there's always a need for liquidity. And notes are one of the most liquid assets that we can own. If you ever need to raise capital fast, you can sell a note very fast. Yep. And raise the capital you need. And so that's wonderful. It gives us a lot of flexibility and options. And isn't that what we all want in life, is to have better choices and options for the things that we want to do?
Absolutely. And one more quick thing, if I may, I know we're kind of running out of time, but to compound on that and going back to, like Fred said, Nate's prior, first question, why notes now? We are seeing, at least those of us that are buying institutional paper, are seeing a huge surge in foreclosure filings. We are up in double digits over where we were last year, which was up double digits of the year before. We are seeing numbers and bad debt coming into the market like we have not seen since 2008. So those of us that have been waiting, and I can speak for myself, I have been waiting and stockpiling some of my own personal cash. that is going to be going into the fund as well. But there are huge opportunities, in my opinion, that I am seeing based on the numbers of foreclosure filings and the banks that have bad debt on their books right now, that there's going to be, in my opinion, a tremendous amount of product that's going to be coming to market probably toward the end of this year, definitely into next year. And I think by the summer of 2027, we are going to be in quite an interesting spot as note investors. I think there's going to be more product than we have to handle. And I think pricing is going to come down as well, which also mitigates our risk and builds in a bigger equity margin.
That's very scary. I mean, that's very scary to me. Those are astounding statistics if we really think about it. But I want to actually ask you about that real quick. Where are you seeing the majority of this happening? Is there a particular region of the country or a particular state?
There are, according to my sources that I pay attention to, there's a lot that's happening, and it's very specific to not just states too, but there's a lot that's happening in Florida. There's a tremendous amount that's happening specifically in Austin, Texas. There are some really key large areas that had a massive influx of people, which jammed prices through the roof. If you remember back in 2021, 2022, with interest rates super low, people are fleeing their state. They're going to these other states that have much less in terms of taxes, et cetera, and lower housing prices. And those prices went up. People could afford, they were overbuying, which is exactly what happened in 2008, by the way. We had, if you remember back in 2005, we had super low interest rates. If you had breath, you got a loan, right? And now we're seeing the same thing. Super low interest rates, the inflated prices, people bought at the hairline, like they can barely afford it, but they could afford it at 2%. And now their prices of the houses are starting to drop because there's a big affordability push, as you know. Taxes have gone up in many states, as you know. People have lost their jobs. So all of those things are playing a factor, and we're coming off of inflation. It's coming down, but it's kind of not fast enough. And so it's an interesting paradigm that we're in right now. And I do see a lot of the same signs that we saw in 2008. And we can capitalize on that and actually position ourselves to help people, and help them get back on their feet, because those of us that went through 2008 now know what to do. So it's interesting. It's scary. It's very scary. And I don't mean to be doomsday, but there is a lot of opportunity that the numbers are showing, at least thus far.
Well, numbers don't lie, only people lie. So
another reason to do notes now is because you can go back in time now. You can buy a note 10 years ago before all the changes, and you can have more of a protected position on the collateral that you might have to foreclose on. So you can go buy it now and go back, or you can start getting ready to buy when the prices compress on the properties, and take advantage of those downtimes. So yeah, sometimes the fear and the greed is part of the marketplace, but we don't have to be with the masses. We can have composure and buy at the right prices. And there's always a time to buy notes if you can buy them intelligently. But that's not always the case with property. Property goes through these real estate cycles that you can see going back 200 years. And there are some bad times to be buying properties. With notes, you can shift the time if you can see it, or you can find somebody who can. Sometimes it's not about how can I, it's who do I know that can do it for me. Because you can take advantage, but you can also make some mistakes, like Paige was saying, and just miss the timing of it.
Yep.
Makes sense. So unfortunately, we're coming up on time, but really want to send appreciations to everybody that joined today. Paige, Fred, Zeke. If each of you could just give your contact information if anybody wants to reach out directly. Paige?
Yeah, if you want to reach out, you can book a free call with me directly on my calendar. Go to Ask Cashflow Chick. That's CASHFLOWCHICK.com. And that link will take you directly to my calendar. You can book a time with me and we can chat. I'm more than happy to answer any questions you may have. Or you can go to my website, cashflowchick.com or thetrilliongroup.com, and reach out that way. I'm available. It'll come directly to me.
Fred?
Thank you. The best way to reach me is through my website, which is at fredmoskowitz.com. And if you prefer a little bit of an easier spelling, you can go to giftfromfred.com. It'll take you right to my website. I have a special report about note investing that I'm happy to send out to you. And you can send a message to connect or learn more about my book, which is called The Little Green Book of Note Investing. And it's a great place to get a little bit more of a deeper dive into this asset class. Thank you. I look forward to connecting with you.
Zeke?
Oh, Zeke, you're on mute.
So the easiest way is just a good old-fashioned email. My email is zeke@snowlioncapital.com. It's ZEKE at snowlioncapital.com.
Thank you, Jillian and Nate, so much for having all of us.
No, this was fun. I really hope some people are encouraged and inspired to start looking into notes, because I will tell you guys, I remember in around 2010, I was sitting in my office and I had a potential client call me at the law firm and tell me they just needed $3 million because they had an opportunity from a bank to buy notes at 3 cents on the dollar. And yeah, and I didn't have $3 million at the time. I don't have $3 million now either, by the way. But however, I think like everything these guys are saying is like, because it's not just like, you know, Paige is the only one looking at those non-performing notes. True. But this is going to send a wave through the rest of the industry. And so it's a great opportunity for a lot of reasons, not just from the non-performers.
Yeah.
Love it. Thank you all.
Thank you. Have a great day. Rest and great rest of your week.
All right.